Something extremely unusual is happening beneath the surface of global financial markets this week. On the surface, the headlines still look calm. Equity markets are fluctuating, central bankers are delivering routine speeches, and the mainstream financial press continues to reassure investors that the system remains stable. But when you step back and analyze the deeper signals coming from bond markets, commodity flows, central bank balance sheets, and geopolitical capital movements, a very different picture begins to emerge. A massive monetary regime shift is quietly unfolding. This is not a normal market cycle. It is not simply another correction or a temporary liquidity shock. What we are witnessing right now is the gradual breakdown of the monetary framework that has governed the global economy for decades.
The financial architecture that shaped the post-2008 era, an environment defined by easy money, aggressive central bank intervention, and the dominance of fiat liquidity, is entering a new and far more unstable phase. And the signs are everywhere if you know where to look. Over the past several weeks, bond yields across multiple major economies have begun moving in ways that central banks are struggling to control. Sovereign debt markets are flashing warning signals that institutional investors cannot ignore. At the same time, global capital is quietly shifting away from traditional financial assets and toward hard, tangible stores of value. This is not random market noise. It is the early stage of a structural monetary transition. For more than 15 years, the global economy has been operating inside an unprecedented experiment in monetary policy. Central banks suppressed interest rates to near zero levels, flooded financial systems with liquidity, and expanded their balance sheets to historic extremes. The justification was simple: stabilize the economy after the financial crisis and support growth. For a time, it worked. Asset prices rose. Stock markets entered one of the longest bull runs in history. Real estate surged across major cities worldwide. Investors were conditioned to believe that central banks had essentially solved the problem of economic cycles. But beneath that prosperity, a deeper imbalance was building. Cheap money encouraged governments, corporations, and households to accumulate debt at levels that would have been unthinkable in previous decades. Global debt has now surged to levels exceeding 3 times the size of the world's entire economy. In many advanced economies, the interest payments on government debt are now growing faster than the underlying economic growth required to sustain them. This is the trap the system now finds itself in. Central banks are caught between two impossible choices. If they keep interest rates elevated to fight inflation, they risk destabilizing heavily indebted governments, corporations, and banks. But if they cut rates aggressively and inject more liquidity, they risk accelerating the long-term devaluation of fiat currencies. There is no painless exit from this dilemma. This is precisely why many institutional investors are beginning to prepare for a new monetary regime, one defined by higher structural volatility, declining confidence in traditional financial assets, and increasing demand for real, tangible resources. One of the clearest signals of this shift can be seen in the global demand for precious metals. Across multiple regions, physical demand for gold and silver has surged dramatically over the past year. Central banks themselves have been among the largest buyers of gold, quietly accumulating reserves at a pace not seen in decades. At the same time, private investors are increasingly moving capital away from purely financial instruments and toward assets that cannot be created through monetary expansion. That trend is not happening by accident. It reflects a growing recognition that the monetary environment of the past 15 years is beginning to change. For decades, the global financial system relied heavily on confidence in fiat currencies, particularly the US dollar, as the central pillar of international trade and capital flows. But in recent years, geopolitical tensions and economic fragmentation have begun to challenge that structure. Countries are increasingly exploring alternative settlement systems, bilateral trade arrangements, and reserve diversification strategies. These developments may appear subtle on the surface, but collectively they represent the early stages of a profound transformation. The global economy is slowly transitioning from a world defined by financialization and limitless liquidity toward one increasingly shaped by real assets, commodity flows, and geopolitical power dynamics. In this environment, volatility becomes the new normal. Markets that once moved gradually can begin to shift rapidly as confidence changes. Capital that once flowed predictably through financial channels may start seeking safety in entirely different asset classes. The assumptions that guided investors for decades may suddenly prove unreliable. This is why understanding the mechanics of the current transition is so important, because when monetary regimes change, the consequences extend far beyond financial markets. They reshape wealth distribution, alter global trade patterns, and redefine the very concept of economic security. History shows that these transitions rarely happen smoothly. They often begin quietly, with subtle signals that only a handful of observers recognize. Then, as more participants become aware of the underlying structural shifts, the adjustment accelerates. We may now be entering that acceleration phase. Over the next several days, a series of developments across global markets could provide important clues about how quickly this regime shift is unfolding. Key economic data releases, central bank communications, and movements in commodity markets will all be closely watched by institutional capital. What happens this week may not determine the entire outcome of this transition, but it could reveal whether the forces driving this monetary shift are beginning to move faster than policymakers can control. And if that happens, the implications for investors, currencies, and global markets could be far more significant than most people currently realize. The question now is not whether the global monetary system is changing. The evidence suggests that it already is. The real question is how prepared people are for what comes next. To understand why this week matters so much, you have to look at the one market that quietly controls everything else, the global bond market. Most people focus on stocks, cryptocurrencies, or commodities when they think about financial markets. But in reality, the bond market is the foundation of the entire financial system. Government bonds determine the cost of borrowing for banks, corporations, and households. They influence mortgage rates, credit markets, and the liquidity conditions that allow financial assets to function. When bond markets begin to move in unstable ways, the consequences ripple through the entire global economy. And right now, that instability is beginning to surface. Across multiple major economies, long-term bond yields have been trending upward despite aggressive attempts by central banks to stabilize them. In the United States, the Treasury market, the deepest and most important bond market in the world, has shown repeated signs of stress. Liquidity conditions have become increasingly fragile, and large institutional players have begun quietly reducing exposure to long-duration sovereign debt. That behavior is not random. It reflects a growing awareness among major investors that the structural debt dynamics of developed economies are becoming increasingly difficult to sustain. Consider the mathematical reality of the current situation. Many advanced economies are now operating with debt-to-GDP ratios that exceed levels previously associated with wartime financing. In the United States, total federal debt has moved far beyond $30 trillion, and the interest payments required to service that debt are rising rapidly as older low-rate bonds mature and are replaced with higher-rate issuance. At the same time, economic growth is slowing. This combination creates a dangerous feedback loop. As governments borrow more money to finance deficits, they must issue additional bonds into the market. But when investors begin demanding higher yields to compensate for inflation and fiscal risk, the cost of servicing that debt rises further. This dynamic is sometimes referred to as a sovereign debt spiral, and it is precisely the kind of environment that historically forces major monetary changes. Throughout history, when debt burdens reach levels that cannot realistically be repaid through economic growth alone, governments eventually resort to monetary solutions. Those solutions usually take the form of financial repression, currency debasement, or structural changes to the monetary system itself. We are beginning to see the early signals of that process. Central banks are now walking a very narrow path between maintaining financial stability and preserving the purchasing power of their currencies. If they tighten monetary policy too aggressively, they risk triggering defaults across heavily indebted sectors of the economy. But if they ease policy too quickly, they risk reigniting inflation and undermining confidence in fiat money. This is the dilemma that is now shaping monetary policy across the world. And it is why the concept of a monetary regime shift is becoming increasingly relevant. A monetary regime shift occurs when the underlying rules governing money, debt, and financial stability begin to change. These transitions do not happen overnight. They unfold gradually as economic pressures force policymakers and markets to adapt to new realities. Sometimes those shifts involve changes in reserve currencies. Sometimes they involve new financial infrastructure or alternative settlement systems. And sometimes they involve a renewed focus on tangible assets that cannot be easily manipulated by monetary policy. One of the most interesting developments in recent years has been the growing movement toward de-dollarization in parts of the global economy. While the US dollar remains the dominant reserve currency today, several large, emerging economies have begun actively exploring alternatives for international trade and financial settlement. Bilateral agreements allowing trade in local currencies have expanded. New payment systems designed to bypass traditional Western financial networks are being developed, and central banks in multiple regions are steadily increasing their gold reserves. These actions may appear gradual, but collectively they represent a strategic shift in how nations think about monetary sovereignty. If a country relies heavily on a foreign currency for trade and reserves, it also exposes itself to geopolitical and financial risks tied to that currency's issuing nation. In an increasingly fragmented geopolitical environment, many governments are attempting to reduce that vulnerability. This is one reason why commodities and tangible assets are playing a more prominent role in global financial strategy. Energy resources, industrial metals, agricultural commodities, and precious metals are all assets that maintain intrinsic value regardless of which currency is used to price them. In times of monetary uncertainty, these assets often become focal points for capital-seeking stability. Gold has historically played this role as the ultimate reserve asset. But silver occupies a unique position in the modern economy. Unlike gold, which is primarily held as a monetary reserve and store of wealth, silver also has enormous industrial demand. It is used in electronics, renewable energy infrastructure, medical technologies, and advanced manufacturing processes. That dual role, both monetary and industrial, makes silver particularly sensitive to changes in global economic conditions. If the world is indeed entering a new monetary regime characterized by higher inflation, supply chain realignments, and increased demand for real assets, silver could become one of the most strategically important commodities in the global economy. This is why so many investors are paying close attention to developments in the silver market. Over the past several years, the supply-demand balance in silver has become increasingly tight. Mine production has struggled to keep pace with growing industrial demand, particularly from the renewable energy sector and advanced electronics manufacturing. At the same time, investment demand has periodically surged during periods of financial stress. This combination creates the potential for sharp price movements when market sentiment shifts. And if a broader monetary transition accelerates, those movements could become even more pronounced. But the critical point here is not simply about the price of any individual asset. The larger story is about the transformation of the global monetary landscape. The system that dominated the last several decades, one built on abundant liquidity, predictable globalization, and relative geopolitical stability, is giving way to a more complex and uncertain environment. Understanding that shift is essential for anyone attempting to navigate the financial markets in the years ahead, because when monetary regimes change, the strategies that worked in the past often stop working, and new opportunities, along with new risks, begin to emerge. But to truly understand why this potential regime shift matters right now, we have to examine one of the most fragile fault lines in the entire financial system: the growing disconnect between paper markets and physical reality. For decades, modern financial markets have operated through layers of derivatives, futures contracts, and synthetic exposure instruments that allow traders to gain exposure to assets without ever touching the underlying physical commodity. In theory, these systems improve liquidity and price discovery, but over time, they have also created a structure where paper claims on assets can multiply far beyond the amount of physical supply that actually exists. This is especially true in the precious metals market. The global trading system for gold and silver relies heavily on futures exchanges and unallocated accounts, where participants trade contracts representing metal rather than the metal itself. These paper contracts are rolled over repeatedly, settled in cash, and rarely converted into physical delivery. As long as most participants accept this structure, the system functions smoothly. But the stability of that system depends on one critical assumption: that only a small fraction of participants will ever request physical delivery at the same time. If that assumption fails, the structure begins to strain. Over the past few years, several signals have suggested that the balance between paper trading and physical demand may be shifting. Physical metal flows across major vault systems have become increasingly volatile. In certain periods, inventories held by exchanges and refineries have declined, while investment demand has surged. At the same time, geopolitical developments have added another layer of complexity to the equation. The global economy is becoming more fragmented. Supply chains that were once optimized purely for efficiency are now being restructured for resilience and national security. Governments are imposing export controls, encouraging domestic production of critical materials, and stockpiling strategic commodities. These policies directly affect metals markets. Silver, for example, plays a critical role in a wide range of technologies central to the modern economy. Solar panels, electric vehicles, advanced electronics, telecommunications infrastructure, and defense systems all rely on silver's unique physical properties. As the world accelerates its transition toward electrification and digital infrastructure, demand for silver in these sectors continues to expand. But unlike many industrial materials, silver production cannot simply be increased overnight. Most silver is produced as a byproduct of mining operations focused primarily on other metals, such as copper, lead, and zinc. This means that silver supply often depends on the economic conditions affecting entirely different commodities. Bringing new silver mines into operation requires years of exploration, permitting, and capital investment. In other words, supply tends to respond slowly to sudden changes in demand. When you combine that structural supply constraint with growing industrial demand and periodic surges in investment demand, the result is a market that can experience sudden and dramatic shifts in pricing dynamics. This is why the concept of a silver squeeze periodically captures the attention of investors. While some discussions around the topic can become exaggerated, the underlying mechanics are real. If enough market participants simultaneously seek physical delivery of silver rather than rolling paper contracts forward, the available supply within exchange vaults can become strained. When that happens, price volatility tends to increase sharply. This is not a theoretical possibility. Similar dynamics have occurred in multiple commodity markets throughout history. Whenever financial derivatives markets grow significantly larger than the underlying physical supply they represent, the potential exists for moments where the two become temporarily disconnected. Those moments can produce extraordinary market movements. And in a broader environment where confidence in fiat currencies is gradually eroding, tangible assets often become the focal point of capital flows seeking security. This is one reason why precious metals have historically performed well during periods of monetary transition. Gold and silver have served as monetary anchors for thousands of years because they cannot be created through political decisions or monetary policy. Their supply grows slowly and predictably compared to the rapid expansion of paper currencies. When investors begin to question the long-term stability of fiat systems, they often return to assets with those characteristics. But the current situation also includes an additional factor that did not exist during previous monetary transitions: the accelerating pace of geopolitical change. Over the past decade, tensions between major global powers have intensified. Trade disputes, technological competition, sanctions regimes, and military conflicts have reshaped the geopolitical landscape. These developments influence financial markets in ways that are sometimes difficult to predict. For example, conflicts affecting major energy-producing regions can drive sudden changes in commodity prices. Sanctions on certain countries can disrupt supply chains and alter global trade flows. Shifts in diplomatic alliances can affect which currencies and financial systems are used for international settlement. All of these factors feed into the broader monetary transition currently unfolding. In the short term, markets may continue to move unpredictably as these forces interact with one another. Sudden rallies, sharp corrections, and unexpected volatility will likely remain part of the landscape. But over the longer term, the structural trends appear increasingly clear. Debt levels remain historically high. Inflation pressures continue to challenge central bank policy. Geopolitical fragmentation is encouraging diversification away from traditional financial structures, and demand for tangible assets is steadily rising. Against that backdrop, investors face a critical decision. Some will continue relying entirely on the financial system that dominated the past several decades, trusting that central banks and policymakers can stabilize markets as they have done before. Others will begin positioning themselves for a world where monetary policy has less control over economic outcomes and where real assets regain a central role in wealth preservation. Neither approach guarantees success, but history suggests that when monetary regimes shift, those who recognize the change early often have a significant advantage. This week may not mark the final turning point in that transition, but it could provide important clues about how quickly the underlying forces are accelerating. Because if the signals emerging from bond markets, commodities, and geopolitical developments continue to align, the monetary regime shift that once seemed distant may soon become impossible to ignore. So where does all of this leave us right now? At the center of one of the most important financial transitions of our generation. For years, markets operated under a predictable framework. Central banks injected liquidity whenever volatility appeared. Interest rates remained historically low. Asset prices were supported by a constant flow of cheap capital. Investors learned to believe that the system would always stabilize itself. But the environment now emerging looks very different. Debt levels have reached historic extremes. Inflation pressures continue to challenge policymakers. Bond markets are beginning to signal stress in ways that cannot be ignored. At the same time, geopolitical fragmentation is reshaping trade networks and encouraging nations to reconsider how they store and settle wealth. These are not isolated developments. They are pieces of a much larger shift in the global monetary landscape. That shift will not unfold overnight. Monetary regimes rarely change in a single dramatic event. Instead, they transition gradually as old assumptions lose credibility and new financial structures begin to form. But once that transition reaches a certain point, the pace of change can accelerate quickly. This week may provide another important glimpse into how far along that process already is. If volatility continues building across bond markets, commodities, and currencies, it could signal that the forces driving this regime shift are strengthening. Investors and institutions around the world will be watching closely for any signs that capital flows are beginning to adjust to a new financial reality. The key takeaway is simple. The global monetary system is entering a period of transformation. Periods like this create both risk and opportunity, but they reward preparation above all else. Understanding the mechanics of money, debt, and real assets becomes essential when the rules of the financial game begin to change. Stay aware of the signals emerging from global markets. Question the narratives dominating mainstream headlines. And most importantly, approach the coming volatility with discipline and clear long-term thinking. Because when monetary regimes shift, the investors who adapt early are often the ones who emerge strongest on the other side.